Good afternoon. Thank you everyone for joining the IIB's webinar today on new licensing requirements for provision of cross-border banking services into Europe. One of our members raised this issue to us, and so we thought it would be helpful for folks to be able to hear from some experts on what this may mean for your operations. So we are very pleased today to have with us A&O Shearman attorneys in the Financial Services Regulatory Practice Group. So we have Lena, Kiely, Bob Penn, and Nick Bradbury, who will discuss the scope and impact of these requirements and what third country banks will need to do to prepare. Links to our speaker bios are included in the meeting invite. And if you would like to submit questions, you can do so in the chat. For those of you that are dialed in, we have provided the slides in the meeting invite, and so you can follow along with the presentation. And with that, I will turn it over to Lena. Thank you.
Great. Thank you very much, Stephanie. Thank you to you, or thanks to the IIB for hosting this webinar today. Good afternoon to all of our participants. We're delighted to be here to talk with you about the proposed European CRD VI requirements. I'm Lena Kiely, bank regulatory partner based at A&O Shearman, based here in New York. Bob and Nick, my partners in London, have been spending quite a lot of their time, among other things that they do, considering the implications of the proposed requirements. And I'll turn things over to Bob and Nick in just a moment to guide us through the details of the proposed rules. But as a US-based bank regulatory lawyer, I wanted to make some initial comments to help provide some context for why these requirements might be relevant in the US in your roles with branches and other affiliates of foreign banks. When considering the potential impact and compliance requirements of CRD VI, the implications for US-based banks and other US financial institutions that have customers in the EU seem obvious, but it is frankly a bit less obvious whether and to what extent there might be impact on a US branch or a US broker-dealer subsidiary foreign bank. So as Bob and Nick have been discussing the proposed requirements with clients, and as we've been having conversations internally among ourselves and with colleagues at the firm, what we're seeing is that it is often that head office of a non-EU bank that is taking the lead on assessing the implications and potential impact of CRD VI. And while the head office has a broad view across the entire bank of various activities that are potentially in scope, they might not be as familiar with the more granular details of how relationships might be structured in the US at the branch level, for example. And so while the initial view might be that there's not really that much to do with respect to implementation and compliance when it comes to branches and broker-dealer subsidiaries in the US, ultimately what we're seeing is that while it's true that there's generally not perhaps a tremendous volume of banking services provided out of the US operations to EU-based customers, such customers' relationships do exist. And so it is still advisable for US branches and US broker-dealer subsidiaries of non-EU banks to review their services provided to EU customers to determine whether this activity would be covered by the new CRD VI requirements. And so, Angela, if you move forward to the introductory slide, we've put up, just to help again with context, just the types of services that would be helpful for you to be thinking about, deposit accounts, loans, guarantees and commitments, trade finance and supply chain finance arrangements, which are very common with branches of foreign banks in the US. Some might be at times complex, where, for example, it might not even be obvious which party involved in the arrangement is technically the customer. And so it, of course, would be relevant for purposes of assessing potential applicability of CRD VI. Customer relationships that may be managed out of Europe by a European EU parent company that has group affiliates, including US subsidiaries, for example, a global corporate treasury function managed at the group level. Again, that might have impact ultimately at the US for the US branches. Notional pooling arrangements, again, another example where arrangements potentially could be complex, could involve multiple parties in different jurisdictions. So again, worth taking a look. And so the general theme kind of that has emerged beyond, identifying some of the obvious products and services provided out of the US to EU customers, such as deposits and loans, it's really advisable to look at the details of the more complex or bespoke arrangements with EU customers where the involvement of the US entities may not be immediately apparent or may need to be reviewed carefully to examine kind of the exact chain of contractual relationships to determine which part of the bank is actually providing the services and whether the US is actually providing services into the EU. So I'm going to turn it over to Bob, but before that, I just wanted to mention we're very happy to take questions as we go along. We're also going to leave some time at the end, but if people want to type questions into the chat or even I think maybe email them directly to Stephanie, we very much welcome that, so we'll be happy to address them as we move through their presentation. So with that, Bob, over to you.
Thank you very much, and good afternoon, everyone. If we could have the next slide, please. I will start by giving a little bit of the background to these new European rules, and then between Nick and myself, we'll dredge a little more into the detail of what's going on and what the implications are for so-called third country banks. But I thought maybe the first thing I should do is just explain what a third country bank is. It may not be clear to all of you. It's a rather strange term, but the term third country for European law purposes speaks to anything that is non-EU, so non-European banks. So we're talking about a new regime that is coming into force that affects only non-European banks. And for those of you who are a little more into the weeds of the subtleties of sort of European legislation, I'm going to use EU as a shorthand actually for the European Economic Area. For those that care about such things, that includes Norway and Iceland and Liechtenstein atop the European Union members. But just think of a map of Europe. Get rid of the UK because we, for better or worse, came out of it. Get rid of Switzerland, which is never really in it. And that's the geographic area we're talking about today. And third country banks are those banks that are headquartered, incorporated outside of it. So just a bit on the genesis of this regime. If we can have the next slide, please. So this regime, which will come into effect practically for firms in January 2027, so it's still a couple of years off, is derived from a sort of long-standing agreement on the part of the European Central Bank about how the central bank in Europe regulates the banking system. So we've had now for getting on for, I guess, just over 10 years, a single supervisory mechanism in Europe whereby the European Central Bank became the sort of single supervisor for systemic European banks. And when that package was originally negotiated, one of the things that the ECB wanted was oversight of non-European banks as well as European banks. And it wasn't given that. And there's been a long-standing sort of whinge from the ECB that they're accountable for financial stability across Europe with no authority over non-European banks doing business in the EU. That's simply left to individual European member states who can decide whether and how they regulate third country banks subject to certain basic minimum requirements. So, this is sort of dealing with a long-standing perceived shortfall in the European bank regulatory structure that was exacerbated by Brexit, of course, because the overwhelmingly largest part of the European banking market sits in the UK. The UK exited the EU, of course, a few years ago, and with it, Europe's banking market effectively migrated to outside of the European Union and outside of the supervisory purview altogether of the European authorities, who in fairness didn't directly regulate before, but at least we were all on the same standards and within the same single market. So, so what we've seen is a proposal that was bundled up with various other aspects of prudential reform, which we'll very briefly touch on, that ultimately came to fruition and final legislation in the middle of last year. And it's in the form of a European directive. So it's a piece of legislation that is aimed at European member states and requires those European member states to make their own law transposing the directive into national law. And so we have a timeline here of, we're now at the beginning of 2025. We've got broadly 12 months, a bit less than 12 months, until European member states transpose the legislation into national law, and then a further 12 months until this licensing requirement that we're going to talk about comes into effect. If we can have the next slide, please. And so, as I said, just briefly, it's the Capital Requirements Directive, CRD, is the piece of European legislation that we're talking about today. The package of legislation that was passed in June included, it was known as the so-called risk reduction package. It included the European version of the Basel Endgame, as I think you refer to it over there. We call it Basel 3.1, having been told we're no longer allowed to call it Basel 4. But also various amendments, various sort of idiosyncratic amendments to European law around ESG and strengthening enforcement tools for regulators. But what we're really going to focus on here, if we have the next slide, is this licensing requirement that affects third country, i.e. non-European banks, where they provide cross-border services into the EU. So Nick will take us through the detail of this, but if there's one thing I'd like you all to take away, is that from that date in January 2027, non-European banks and large broker-dealers, what we refer to as third country institutions, will require a branch license where they provide core banking services, which is to say deposits, loans, guarantees, and commitments in a member state, i.e. presumptively to a recipient of those services that's situated in Europe, unless there is an available exemption. And there are thankfully simple, very small number of exemptions covering intra-group, interbank, and reverse solicitation-based services. And the effect of that licensing requirement is to impose an obligation on the affected firm, on the affected bank, to establish a licensed branch in the relevant European member state where the customer is situated. Of course, in practice, there are over 20 member states. So in principle, that would equate to establishing 20 plus branches if you have service customers all the way across Europe. In practice, of course, that will be incredibly inefficient thing to do. And so in practice, firms, and of course, many of your organizations will already have European bank subsidiaries which benefit from so-called passporting rights across the single market. Firms will generally be expected to transfer that business into a passported subsidiary. But anyway, maybe over to you, Nick, to kind of unpack the component parts of this in a bit more detail.
Great, thanks very much, Bob. So if we just go on to the next slide, please. So as Bob says, what I'm going to do in this section is just drill down into each of those components that make up the overall test and give you a bit more detail on what would be in scope for the new branching requirement. So starting with who is captured by the prohibition. So this is one of those strange EU tests that you may have seen in other pieces of EU legislation, such as EMIR, our equivalent of your Dodd-Frank derivative rules, where you have to ask a sort of theoretical or hypothetical question. What would the entity that's outside the EU, how would it be classified were it in the EU? Which is a sort of formulation used, as I say, in other pieces of legislation, but requires you to sort of take the entity that's outside the EU and apply European law to it to try and classify it, which isn't always a straightforward exercise. And just to be clear what that could include, so that could include a US incorporated company, would obviously be a third country non-EU entity. It could include such an entity even where that entity is part of a group which you might say in a broader sense is an EU bank. So it might be an EU headquartered banking group that has licensed EU banks or other entities in the group, but you're the parent or the subsidiary of that entity outside the EU, so in your case in the US. So that would also potentially be in scope if it meets the other requirements. It could also include a branch of a EU entity in the US, for example. So I think we had a good question in advance of the session about the so-called concept of back branching, which effectively would be where you had, say, a French bank or a German bank, for the sake of argument, that had a US, say, a New York branch, and that branch wanted to provide services back into the EU. There is a question as to whether, because it's part of the same legal entity, it could do that using the legal entity's EU permissions, including the EU passport. There has been some debate around that, particularly in the Brexit context, but I think our firm and I think most others now take the view that isn't permissible. So even those branches of EU incorporated and licensed banks that are where the branches outside the EU would also be within the scope of this. So it is quite broad in that sense. And as I say, you have to apply a theoretical question of what would that entity or branch be were it operating in the EU. And there's basically two limbs that are caught by the new test. So you basically have to qualify as what's called a credit institution under EU law, and there are two ways of doing that. The first is generally pretty straightforward to identify because it is an entity that accepts deposits and lends. So it's not, there may be some fringe cases, but it's typically quite straightforward to identify if you're accepting deposits or not. The second limb is quite different. It is a bit of a bit of a scope nightmare, I would say, in terms of whether you're caught by it or not. What it broadly captures is large investment firms, and investment firms is EU speak or EU law speak for broker dealers, asset managers, custodians, and probably a few other types of entities. But basically, it's the rest of the financial sector other than banks, obviously excluding insurance and other types of regulated entity. And then there's also a size test, which is where the nightmare begins, because if you wanted to find an example of a convoluted way of drafting your scope test, if you get a chance, have a look at this section of the CRR, which is the sister piece of legislation to CRD. It's about a page in length of drafting in the legislation, and I won't go into all the detail because it would probably take the rest of the session, but there's a variety of very, very convoluted tests in that page of drafting that describe when you qualify as large for these purposes. Be careful with this slide. So the bit that describes that is very much paraphrasing that page. So don't interpret the slide as if it covers all the different concepts that are in there. But in short, the key threshold is 30 billion euros of assets on a consolidated basis in the EU, in the broader group in which the relevant third country entity sits. It's not as simple as that. There's all various sort of strange and convoluted ways in which it's described, which I won't go into. But in short, if you think you're in that region, then you need to be quite careful in how you work through that. And most people are getting external advice to try and interpret some pretty unclear parts of the drafting as to what exactly it captures. It's a bit of a case study in over-engineering and convoluting legal drafting. So I won't say any more than that, but it is something that requires quite a bit of work to work through the different components of it. If you could go on to the next slide, please. So as Bob mentioned, there's basically 3 buckets of activity that would be caught. So accepting deposits, as I say, generally reasonably straightforward to identify. Lending and guarantees and commitments. One of the troubles that predates this new legislation and is carried forward into this legislation is that those terms are not defined or expanded upon through definitions or guidance or other regulatory means to give you a bit more clarity as to what they might capture. And lending, for example, is obviously a term that could capture quite a wide range of activities. There is a bit of guidance in the legislation itself, so it is very broad. It captures consumer lending, not just wholesale, credit agreements relating to immovable property, so mortgages, factoring with or without recourse, and financing of commercial transactions, including forfeiting. So that's non-exhaustive. That is a range of types of lending that would be caught. But of course, if you start drilling down into it, there's a whole range of different activities that might be caught by that. So commodity finance, trade finance, 2 other examples of quite complex products where you need to work out if you're within the scope of lending or not. Then there's the more sort of problematic ones, like a derivative with embedded financing in it. Is that lending, or is that a derivative, or is it some sort of hybrid between the two? Those need to be carefully worked through, and there's relevant exemptions that I'll come on to talk about. So in short, it's very broad. It doesn't exclude very much that has any element of an extension of credit in the product or embedded into the product. And it's not always immediately obvious for many cases where to draw the line. There's a clear core, which is very obviously lending, and then around the edge of that, there's a large range of activities where you have to do a bit of analysis to work out if you're within scope, and there isn't much guidance to tell you how to do that. Guarantees and commitments. So get guarantees on or off balance sheet, generally not too difficult to identify what a guarantee is. More difficult to identify where a guarantee is being performed, which is a point I'll come on to. And then commitments is off balance sheet exposures, such as an undrawn commitment to lend, would also be caught, as well as actually extended financing. So if you're doing any of those activities with EU clients, you need to be thinking about, from outside the EU, cross-border, you need to be thinking about whether this new requirement to establish a branch is going to bite. So whether you're doing one of those 3 activities, and if you are, whether there's an exemption available. So I'll come on to the exemption shortly. If you go on to the next slide. So the next component is the activity has to be conducted in a member state. And historically, before CRD VI, this wasn't harmonized across the 27 EU member states. So each member state had freedom to take its own interpretation of when a financial service is provided in inverted commas, that member state. And obviously with cross-border services, that can raise quite difficult questions as to whether it trips the territorial scope of that member state's jurisdictional reach. And yeah, as I say, that there are a range of different tests that were adopted to do that across different member states, some being more liberal, others being more conservative. One of the sort of new features of this is that it, for the first time ever really, actually will probably harmonise that test more than it ever has done, in the sense that the Commission's, so the European Commission's anticipation was that effectively where you have an EU client, that constitutes providing the service in that member state. So even if you have no physical presence there, and you're contracting on an entirely cross-border basis, none of your staff ever visit that country, as long as your counterparty, your client, is in the member state, then that is in a member state, which, as I say, is more restrictive for many jurisdictions in the EU, and it's also new. It is not yet entirely clear whether this gives member states a bit of wiggle room to say we can take incoming services outside the scope of this legislation by our interpretation of what in a member state means. So some of the more liberal jurisdictions, such as Luxembourg is a good example, would have been the UK, were we still in the EU, but we're obviously not. And there's a few others adopt tests that are a little bit more liberal and would say simply by having an EU located client doesn't necessarily mean you're providing the service in that member state. So they may have some scope in their national implementation of the EU rules or through regulatory guidance that comes out over the next 12 months or so to slightly water down the application of this and take a more liberal approach as to whether this is actually in a member state or not. But it's unclear because it's not clear whether whether any member state will want to do that or whether they will be allowed to and be viewed as having implemented the legislation in accordance with their EU law requirements as a member of the EU. So one to watch whether a minority of countries make this a little bit less restrictive than it first appears by using this concept to narrow the scope of application. Next slide, please. So coming on to the exemptions, so there's 5 main types of exemption here, which I will go through. The first one is a very important one. So where the core banking services, so 3 buckets of activity that I talked about, are ancillary to MiFID investment services, those will be exempt from these requirements. So say, for example, you have a derivative relationship that has an embedded lending or financing arrangement in it, that will probably be within the scope of the MiFID exemption, MiFID dealing in derivatives being a MiFID activity. Prime brokerage, for example, obviously has financing included in the package of services given to the fund clients, but there's also typically MiFID business in there, so clearing transactions or executing transactions or entering into stock loans, probably a range of different MiFID activities alongside the financing. So again, hopefully that will be viewed as out of scope. This is a bit blunt in the legislation. There isn't much guidance on what ancillary means, and obviously that's quite a subjective term. So hopefully we'll get some EU level or member state level guidance explaining what the breadth of this exemption is and what ancillary really means for these purposes. But for broker dealers in particular, that could well take a lot of your activities out of scope because you would likely be lending or accepting deposits alongside a range of activities which are MiFID activities. So dealing in investments, arranging transactions in investments, those are all MiFID activities. So again, to be clarified in due course as to quite what the parameters of that exemption are. Interbank services, helpfully, are exempt, and by the middle of this year, so July this year, the EBA, the European Banking Authority, is due to publish guidance on whether interbank here can be extended beyond true bank to bank, so sort of deposit taker to deposit taker activities to a wider range of financial sector entities. So in broadening out the scope of that exemption to a sort of more financial institution to financial institution type of basis. So again, the devil will be in the detail of which financial sector entities that applies to, but again, that could be quite a helpful broad exemption in interprofessional markets. Intergroup services are exempt, so that could be quite helpful. Could leave some room for structuring back-to-back arrangements if you have an EU entity facing clients and back-to-back lending between group entities. There may be some scope to use the intergroup exemption, but again, a bit unclear at this stage what will be allowed and quite how that will be interpreted. Reverse solicitation is another really important one that a lot of people have got their fingers crossed will be one of the main means of getting their activities outside the scope of this. So just for the avoidance of doubt, obviously reverse solicitation means where you're not marketing the services to EU clients. They are approaching you and asking you to provide the loan or to accept your deposits. Always been a very nebulous concept under EU law. It's not particularly well defined, quite difficult to rely on as a basis for a full business model. Might be useful on a more ad hoc basis for particular client relationships, but hopefully we'll get some more guidance telling us what this particular use of reverse solicitation means in this context, and hopefully it'll be defined quite broadly, which could enable quite a lot of the professional wholesale market activity to be taken out of scope. And then finally, grandfathering. So there's a sort of cut-off date by which activities conducted before will be allowed, where they would otherwise contravene the provision after January 2027, and that cut-off date is the 11th of July 2026. So contracts entered into before that date are grandfathered forward, and it's new business post that date that you need to worry about in terms of the new branching requirement. Next slide, please. So yeah, just very briefly to wrap up for me by way of a very quick recap of what I've just said. So scope, it's third country entities, including branches of EU incorporated entities or large investment firms meeting a complex size threshold. The exemptions, I won't repeat those because I just spoke to them. So you've got those exemptions with quite a lot of detail to be fleshed out in precisely how broad they are or narrow, and the extent to which you can rely on them, and a grandfathering regime. The activities in question are the core banking services, lending, accepting deposits, guarantees, and commitments. And if you fall within scope of this and you can't rely on exemption or you can't be grandfathered, you've got this really quite strange requirement to establish a branch in each member state. So unlike the passporting, this isn't establishing one EU entity that then can provide the services around the EU under a passport. This is if you've got customers in 20 member states, in theory, you've got to establish 20 branches to serve them. Not that anyone believes anyone's going to go down that road for obvious reasons, not at all practicable or realistic that people will be wanting to do that as a means of complying with this. And we'll come on to talk in a moment just about what other means there are and other ways that you might comply with it, short of going down the unlikely event of establishing a full branch. And the key date is the 11th of January 2027, when these requirements all kick into force. So I'll pause there and hand back to Bob.
Thanks very much, Nick. So there we are. So that's a summary of what I think is hopefully a fairly conceptually straightforward piece of law, right? We're saying, you need a license if you're doing banking services, core banking services into a European member state, unless you're within an exemption. But it's helpful to contextualize this a bit more to give the overlay of where we're kind of going from and to, if I can put it that way, because as was mentioned at the outset, today, the position pre-CRD VI implementation across Europe for banking services is completely unharmonized. It's not provided for by European law in any terribly meaningful way. And so you start out today with a patchwork of regulatory regimes under each European member state's own rules that tell you whether, and if so, how you can deliver lending, guarantees, commitments, deposit taking today. And so what we've sought to do, and I have to warn you that all of my continental European colleagues loathe me for doing this, if we can have the next slide, please, is to summarize in a very, very simplistic way how at least I think of cross-border licensing rules as they apply today if you're a non-European institution looking at providing banking services into Europe. I do need to give the health warning. This is obviously, it will be clear to you all, an incredible simplification of some fairly knotty technical legislation. So please do not, under any circumstances, rely on this as legal advice. But it does, I think, nonetheless paint a useful picture. And it is the way I actually think about cross-border licensing when considering as say, European access rights. And the way I do it is to paint a picture of European member states and say to myself, are they green? I.e., are they completely liberal, are they permissive of an activity? Are they yellow? Do they give you access rights subject to conditions or being within exemptions? Are they light red in that they'll permit reverse inquiry-based business, i.e. if someone picks up the phone to you from that jurisdiction and says, I'd like to borrow or I'd like to place a deposit, is that permissible? Or are they dark red, in which case basically the answer is no. There's just pretty well no means of access. Again, this is a gross oversimplification, but it is, I think, a good, sensible starting point of looking at things. And so one important point to make is, as well as it being a non-harmonized picture, that regulatory framework differs typically in most member states between lending and deposit taking, and guarantees and commitments will typically be bundled into lending for these purposes. So you actually have different licensing requirements under the sort of for the different activities. But when you look at the map, you can see that Ireland, some of the Scandinavian jurisdictions, Luxembourg, which is the tiny dot between France and Germany, and the Netherlands and Austria are green for, Czech Republic, are green for corporate lending. Basically, it's unlicensed. You can lend freely into those jurisdictions. And of course, in practice, for global financial institutions, Europe as a market is very focused in lending terms on Luxembourg, because Luxembourg is our kind of our onshore tax haven, and Ireland, because Ireland is also a low tax jurisdiction that has positioned itself very well for treasury functions of big corporates and banks. And so those two jurisdictions are the really sensitive ones, Ireland and Luxembourg. Green today. You then have your yellow jurisdictions, as say you can access with subject to qualifications, the light red jurisdictions, which you can get into on reverse solicitation. There are other things at play here as well. There are cross-border licenses and similar concepts available in some of these jurisdictions, but it gives you a rough picture that actually, when we're looking at these inbound license requirements, it's the ones that are green or yellow today that you really need to worry about, because when you look at the slide, next slide please, you can see the effect of the change we've talked about is to turn those to light red. So they've gone to a situation where effectively your only means of access for corporate lending is reverse solicitation. Similarly, the picture is a little bit different on deposits, because most jurisdictions, obviously deposits are, the essence of what it is to be a bank. So if we have the next slide, please. So if you look at the position for deposit taking, generally member states are much more hostile about cross-border deposit taking. Again, this is high level, and there are complicated rules that sit underneath it. But as a general proposition, most European member states either have a more or less blanket prohibition on cross-border deposit taking, or permit it subject to reverse inquiry more or less only. And so there you can see, moving on to the next slide, the position isn't really changing so dramatically as a result. And in connection with that, therefore, when looking at implementation, when those of you that are working in non-European banks that have activities, a lot of the focus is on lending, because frankly, that's probably the most cross-border of all activities. And that's where you've got the most change. You've got a situation where you may have been merrily lending into Ireland, Luxembourg, Netherlands, potentially Spain, sometimes Germany. Lots of international banks have cross-border licenses that permit activities into Germany, and that's being taken away from you. So that's a rough picture of kind of how you get to the before and after, accepting, as I've said now several times, that these maps are only a very, very illustrative guide, and the position is much more complex. Associated with this requirement, and another change that's very important, I think, particularly as we think about reverse solicitation, next slide, please, is also reporting. So today, if you're doing business cross-border from the US, or Switzerland, or indeed the UK into Europe, based on these existing regimes, or based on reverse solicitation where it's available, that's completely invisible to the regulator. They've got no oversight of it, and it's therefore very hard for them to identify it, quantify it, and challenge you about whether you really are playing by the rules and only lending where someone has come to you on on its own initiative to ask to borrow. And so part of this package it has as its aim putting in place reporting obligations to get greater transparency for the European authorities as to what cross-border business is being conducted, particularly based on reverse solicitation, so they can see it, they can police it, and potentially they can sanction firms for it. And we've seen in the last maybe 3 years or so, the European Central Bank go out to a number of international banks. I've certainly had a couple of Canadians, a couple of Australians, a couple of US banks with European affiliates, where the ECB has gone along to the European affiliate and said, we want information about all your global cross-border flows from all of your banks and all of your regulated entities into the EU. To which we've generally said, we're not going to give you that information. We probably can't even find it. Although latterly, I think firms have kind of sought to be helpful there. But you can see a world in which not only are there are clear European law restrictions saying, well, you can only do this based on reverse solicitation or one of the other 2 exemptions, a regime that bolsters that with reporting and potentially, I guess, sanctions associated with that to the extent that you have an EU presence, starts to make people sit up and maybe give a bit more thought to the risk profile associated with relying on reverse solicitation. So moving on, I suppose, to transposition and implementation issues. Nick, do you want to pick this bit up? Shall I do it?
Yeah. I hadn't planned to, but I
certainly
can.
I'll do it, that's fine. So
sorry.
On to the next slide. So clearly we've sort of illustrated this licensing regime, and in terms of, and so it's very high level, but associated with it, there are a ton of what we're going to term known unknowns. So items where, obviously it's a piece of European law. We don't yet have these underlying bits of legislation that will implement the law into individual member states' regimes. So there are a number of open questions which obviously make planning harder for firms because you don't yet really know what the outcome is going to be. Territorial scope, this exemption potentially for financial sector entities on top of interbank activities. How people will think about grandfathering. We haven't really talked about grandfathering, but grandfathering will enable, it has as its purpose enabling EU purchasers of services to benefit from acquired rights. So if I've acquired, if I've acquired the rights to borrow from a US bank in advance of the grandfathering date, which is 6 months before implementation, so in the summer of 2026, the idea is I shouldn't have that right taken away from me just because of this legislation. Sounds so far so easy, but then you start to ask questions about that, going, well, what happens if my contract changes? If I've got a revolving loan, if I've got just as an individual, if I've got a credit card, I get grandfathered, that's great. Well, if I draw, then pay back, then redraw, does the grandfathering still apply? Answer, there is no answer yet under European law. Similarly, can the lender offer, or can I ask for an extension to the commitment? Can I ask for my credit card limit to be increased? Again, no answer. So there's sort of lots of work, I think, still to be done around grandfathering. I think plenty of firms will rely on it. But there is definitely going to be some wrinkles there around things like restructuring or changes to contractual terms that may take people out of scope. Other sort of classic key sort of known unknowns are actually, what does it mean to be lending? Will that include the negotiation of a loan? Will it include acting as an arranger on a loan? Will it include loan brokerage? Will it include acting as an agent on a loan? Probably not, but the key is in the word probably. So there are lots of kind of items that will still need to be run down. Similarly, questions about if you've got an agent. So let's say you've got a Cayman Islands fund acting through a French fund manager. Okay, so who's buying the service? Is it the fund manager, in which case I'm probably in scope of the licensing requirement because that's a French entity? Is it the Cayman fund, in which case I'm outside of scope? Again, no answer yet. The directive doesn't give us an answer to that question. So lots and lots of things that are still unknown, which will probably crystallize either through European guidance or more likely, frankly, just through having to go through the hard miles of going around individual member states and going, well, what's the local legal answer under the local implementing legislation? If we just move on to the next slide, please. So we've mentioned, obviously, that this is a branch licensing requirement that will never be met. Almost no one will establish a branch, no organization I deal with, bar maybe one or two very, very idiosyncratic examples, will establish this. So what actually are firms doing? What are you or your peers doing, typically, as I said, at the headquarter level for non-European banks? Well, it's about going away and identifying what are my entities within scope, right? So where have I got a bank or a large broker-dealer that's providing these sorts of services to European customers, working out which products are in scope. Obviously, it's pretty straightforward for a lot of things, but there will be some products where it's perhaps a little bit unclear whether a particular product is within the boundaries of the licensing requirement. And then you use that, of course, to build a picture of, well, where are my revenues at risk? And then what do I do? What are my options? And the options here are, again, relatively straightforward. In theory, you could put things into branches. In practice, you'd end up putting things into an EU subsidiary. All of the major banks, pretty much every one of the top 100 banks in the world that is internationally active, has a European banking subsidiary. There are only a few examples now that do not. And so the obvious thing there is you say, okay, well, I'll migrate that affected business that's subject to this licensing requirement into my EU subsidiary. But of course, that carries costs. It's more costly to operate through EU subsidiaries. Once you're below the kind of the mega banks of the world, most EU subsidiaries are capital intensive and actually don't make a lot of money. So there's there are trade-offs about continuing the business versus relying on exemptions, just saying, actually, I don't want to do that. And actually, I'll just narrow my business. I'll grandfather the business that I've already got, and then I'll rely on exemptions. I'll wait for people to come to me. Although, as Nick has said, it's a bit of a risky strategy as it requires you to be able to demonstrate to your regulator that they came to you and not the other way around. Or interestingly, there's an option of migrating lending business where lending is unregulated today, as it effectively is in Luxembourg and Ireland, into an unregulated entity. This regime only applies to third country banks and large broker-dealers. So if you're an unregulated lender, and you can lend today, then presumptively you'll be able to lend tomorrow as well. And so for some US institutions, some US banks, US banking groups do have unregulated lending entities through which they conduct various lending activities. And that presumptively will actually remain unaffected by this regime in exactly the same way that those of you that work for European banks will be unaffected by this regime, because it just doesn't affect you at all, because it just doesn't apply to you. So there we are. So that's the kind of the overview of options, and I very much, in a very flippant way, say this feels to me like a kind of go big or go home moment for a lot of organizations, by which I really mean, that this regime is there to sort of pull in activity. Europe wants it wants a European financial market populated by European market participants. And so they really want you to subsidiarize. They want subsidiaries in Europe, bank full-fat subsidiaries with their own risk management, their own resources, hopefully paying lots of juicy tax revenues to the relevant EU member state. If you're not in the position of having sufficient scale to run a subsidiarized business on a profitable basis, I think life becomes very hard, though. And we've seen this copiously through the Brexit experience, where, as I say, everyone outside, I think, of the bulge bracket banks, they've all established European affiliates. They're very small. They've typically got, a few dozen people, no more, in them. But they've struggled with expectations around the appropriate amount of resource that they need, and capital, and large exposure limits, and these sorts of things. It makes it hard to run a banking business. It's hard enough to run an investment business on that basis. Running a banking business on it is very difficult. And so I think there will be a number of firms for which this is sort of as I said, there's a sort of squeezed middle here of firms that have European franchises, want to maintain them, but will face some quite hard choices because it's hard to build a sufficiently profitable business whilst effectively carving off part of your balance sheet and putting it into this smaller, less well capitalized, and fundamentally more expensive entity to run. So on to the next slide. What should you be doing? Well, as it brings us back to where Lena started, we fully expect that for many of you, this is not, thankfully, the center of your attention. I'm always telling people this is an enterprise-wide job dealing with CRD VI if you're at an international bank. And so if you're, if you're not HQ, then possibly it is a little bit more on the side of your desk than in the middle of it. But I think it is important to be aware of it, and particularly, I think, as we've seen, banks, firms start to get their arms around the directive and what it means. Sometimes you will invariably run across, shall we say, political issues, or we'll be talking to people in London who will say, well, of course, we've got this all sorted out. But of course, they've never spoken to anyone in head office, and they've got no idea what you're doing in America that might touch the European customers, which is why we felt it was appropriate to give this presentation to you people as well. But in practical terms, as I say, what should banks be doing? Clearly, it is, if you haven't already done it, it is the identification of affected entities, affected services. What are the revenues at risk? You're starting to make a plan for how you reconfigure business that's conducted into Europe, which, as I said, generally will involve one or both of that sidestepping based on exemption or unregulated entities, or moving things into subsidiaries. And some of that, of course, can be quite long and time consuming. Some of the businesses we're talking about here are either balance sheet consumptive, very expensive, and or they're operationally intensive. So we're helping out one US institution that's going to have to transfer a custody book. And custody is a disaster, frankly. It's a transfer. It's just very operationally intensive. Very idiosyncratic as to the rules that apply from jurisdiction to jurisdiction, and so migrating it is probably a more than 2-year project, and they've only got 2 years now to do it in. So we'd finished up, and we won't go through them. We'd left a sort of a high level roadmap document that we came up with some months ago for an international bank looking at this. Which we felt might be useful to those of you that have an interest.
Bob, I just wanted to flag, we also have a question in the chat, in the Q&A, again, about the definition of third country branch. So I don't know if you have a minute, or maybe we can also respond after the webinar, but just if you take a quick look at that.
Yes. Well, okay, I think Nick is helpfully tapping out an answer at the moment to that.
Okay. Okay.
More generally, we've sort of got three minutes up. Oh, CLE code. I know that's the most important thing that everybody.
Unfortunately, I think this presentation was not CLE eligible, so apologies for that. If you have us back for the next one, we'll definitely make sure that we set it up for CLE credit. But Stephanie, I don't think we've done this for CLE.
That's correct. Sorry.
Well, I hope we don't feel no one feels that we've frauded them of an hour of their lives. I know in the UK, when we had these sorts of rules, I used to deliberately do talks on incredibly obscure things on about the 30th of October, which was the end of the CLE year. And you'd watch as hundreds of people would turn up to listen to me talk about conglomerates regulation. It was always very good fun. Look, we'd like to thank you all very much for your time. As Lena said at the outset, we're obviously thrilled to help any of you with any questions. So do feel free to get in touch if you have any, because we're always very happy to chew the fat on the sorts of issues here. And frankly, it can be very useful to us to share thoughts and get your perspectives. So maybe with that, if I can hand back to you, Stephanie, to close off.
Yes, so thank you. This was very informative, as you could see from the number of people joining and the number of questions we received in the chat. So thank you, Liana, Bob, and Nick for your time and your expertise, and we look forward to the next one.
Thank you very much. Have a great day, everyone.
Thank you.